If you want to invest or speculate, CFDs and deliverable assets are both options with potential capital gains. Should you decide between them, or do a bit of both? For beginners to investing and trading, saving accounts, rated bonds, and exchange-traded funds, or ETFs for short, are normally very low risk. However, they also usually come with low rewards. If you're an experienced investor willing to accept more risk for a higher potential reward, leveraged derivatives like CFDs are worth considering. You can trade shares as deliverables or as CFDs. With deliverable shares, you're buying an actual stake in a company, which comes with voting rights and, most of the time, quarterly dividends. If the price goes up, you can sell your shares to make a profit. Shares are usually more volatile than Forex, but not as much as cryptocurrencies. The value of a share depends on the company's performance, developments in the industry, and overall economic conditions. With CFDs, you don't own the underlying asset. Instead, you're speculating on changes in its price and exchanging the difference with your broker. CFDs are suitable for relatively short-term trading and speculation because most fees are usually lower and execution is faster. Deliverable assets are better for investing because they involve ownership and, usually, dividends or some other kind of regular yield. The yield is normally higher than any time-based fees for deliverables, with some exceptions, such as tech shares with small real dividends and metals. Another key difference is leverage. For deliverables, you need to cover the full price of whichever shares or other assets you want to buy. That's not the case with CFDs, because leverage allows you to trade on margin. For example, if you're using 1:50 leverage, each real dollar you deposit allows you to control $50 for trading. Leverage is usually good for experienced and successful traders because it makes profits bigger, other things being equal. However, leverage can be disastrous for inexperienced and reckless traders. It's much easier to lose a lot of money quickly with leverage. With CFDs, you can access a range of instruments: Forex, commodities, indices, shares, and cryptocurrencies from one account. However, remember that being able to trade more volume means that both potential profits and potential losses are higher. So always use leverage with caution. For all of these reasons, people usually invest in the long term with deliverable assets and speculate or trade in the short term with derivatives like CFDs. What's best for you? Only you can answer this question conclusively, but for the average person, it might be a good idea to do a bit of both. Once you've tried investing and have allocated some capital into ETFs, fixed-term savings, and possibly others, you can use some of the proceeds to try trading. Experiment with different approaches. Find what works for you and gradually scale up if you're ready. Different approaches and types of instrument in combination can help you find what you're looking for. This isn't advice or recommendation to act. Do your own research and never invest, deposit, or trade more than you can afford to lose.